Here's the thing, right now, somewhere in your portfolio, there is a stock you bought for a reason you can no longer fully explain. You saw the name. You saw the word AI attached to it. And some part of your brain, the same part that once made our ancestors chase shiny objects across a riverbank, whispered, "Get in before it's too late." That whisper is not investing. That whisper is speculation wearing a very expensive disguise, and today we're going to pull that disguise off piece by piece. Let's start with a story, because this always starts with a story. In late 1999, a woman named Barbara worked as a schoolteacher in Ohio. She had never bought a single share of stock in her life. But her brother-in-law kept talking about a company called Pets.com, and how the internet was going to change everything, and how anyone who didn't get in now would regret it forever. So Barbara took $8,000 of her retirement savings and bought in. 14 months later, that $8,000 was worth $340. That's it. Not because the internet was a lie. The internet changed everything, exactly like everyone said it would. Amazon is proof of that. Google is proof of that. But Barbara didn't invest in the internet. She invested in a feeling. And that is the exact same feeling millions of people are chasing right now with artificial intelligence. Here's what nobody wants to say out loud. The technology being real and the stock price being justified are two completely different questions, and most people are only answering one of them. Think about your own behavior for a second, and I want you to really sit with this one. When you hear a company mention AI in its earnings call, does your interest in that stock go up? Even slightly. Be honest. Researchers at the University of Florida actually studied this exact phenomenon in 2023. They found that companies which simply added the words AI or artificial intelligence to their name or their public filings saw their stock price jump by an average of a mind-bending amount, sometimes over 100% in a matter of days, with zero change to their actual revenue, zero change to their actual product, zero change to anything except the label. One company literally renamed itself from Long Blockchain Corp. To something with AI in the title, and the stock spiked before a single line of new code was written. That's not a market pricing in future earnings. That's a market pricing in a story, and stories are exactly what speculation is built on. Now, here's where it gets uncomfortable because I'm not telling you AI is fake. I'm not telling you these companies have no future. What I'm telling you is that your brain cannot tell the difference between a good story and a good investment. And neither can mine, honestly, without doing the work. This is backed by decades of behavioral finance research, going back to economists like Robert Shiller, who literally won a Nobel Prize partly for proving that asset prices move on narrative and herd psychology far more than they move on fundamentals in the short term. He called it narrative economics. The idea is simple but brutal, a story that spreads fast enough, that feels urgent enough, that makes you feel like an idiot for not participating, will move price regardless of whether the underlying business can ever earn back that price in real profit. So let's talk about what you're actually doing right now, because I think you're doing one of two things, and I want you to recognize which one. The first thing people do is what I call proxy panic buying. This is where you don't fully understand a specific AI company's business model, its margins, its competitive moat, or its path to profitability, but you buy anyway because you're afraid of missing the next Nvidia. And look, Nvidia's rise has been staggering, genuinely one of the great business stories of this decade. But here's the part people skip. Nvidia's rise was built on selling something physical and measurable, chips that other real companies desperately needed and were willing to pay real, growing profits for. The company had actual earnings catching up to actual demand. That is fundamentally different from buying a small-cap company because its slide deck has the word AI on it 11 times. The second thing people do, and this one stings a little more, is what psychologists call fear of being left behind or FOBLY. It's cousin to FOMO, but more specific. It's not just, I might miss a gain. It's everyone around me is getting rich and I am going to be the person at the dinner party in 5 years explaining why I didn't buy in. That fear is not financial analysis. That fear is social anxiety wearing a ticker symbol. And Wall Street knows this. This is exactly what happened during the dot-com bubble, exactly what happened during the crypto boom of 2021, and it's happening again right now just with a new 3-letter acronym doing the emotional heavy lifting. Let me give you the test that separates investing from speculation because this is the part you can actually use starting today. Real investing asks one question above all others. Can this business generate enough future cash flow to justify what I'm paying for it today? That's it. That's the whole game, stripped of hype. Speculation asks a completely different question. Will someone else be willing to pay more for this than I did, regardless of whether the underlying business ever earns a dime? Notice the difference. One is about value. The other is about vibes. So here's your homework, and I mean this literally. Pull up whatever AI stock you're holding or considering right now. Just one number, current revenue. Now look at the current valuation. If the company is valued at, say, 50 times its actual current revenue, ask yourself honestly, what does this company have to become, not might become, have to become, for that math to work out? Does it have to be bigger than Google? Bigger than Apple? Does it have to dominate an entire industry that doesn't fully exist yet, with zero serious competition ever emerging? Because that is the actual bet you are making when you buy at that price, whether you've said those words to yourself or not. This is where I get slightly frustrated, honestly, because so many people skip this 5-minute exercise entirely. They see the chart going up and to the right, and the chart itself becomes the evidence. But a chart is not a business. A chart is a record of other people's emotions over time. The math is uncomfortable, but it's real. And avoiding the discomfort doesn't make the math go away, it just delays the moment you have to face it, usually at the worst possible time, usually after the price has already fallen 40 or 50%. Let's talk about the AI companies that might actually deserve real investment, because I don't want this video to leave you thinking every AI stock is a trap. That's not true, and it's not the point. The companies worth studying seriously tend to share a few boring, unglamorous traits, and boring is exactly why most people scroll past them. They have existing profitable business lines that AI is enhancing, not a business built entirely on the promise of AI someday working. They have pricing power, meaning customers already pay them and would keep paying even if the AI hype cooled off tomorrow. And they have management teams that talk about unit economics and customer retention far more than they talk about the future of humanity. Genuinely transformative companies rarely need to remind you constantly how transformative they are. The evidence just kind of speaks for itself quietly in the numbers. Contrast that with the pattern speculation always follows, and this pattern repeats with almost scientific reliability across every bubble in market history. Stage 1, a genuinely revolutionary technology emerges, and it's real, this part is never the lie. Stage 2, early investors make extraordinary returns, and their stories get amplified everywhere, on podcasts, on social media, at dinner tables. Stage 3, a wave of newer, weaker companies rush to associate themselves with the technology, often with far less substance behind them. Stage 4, retail investors, driven by fear of missing out rather than analysis, pile into Stage 3 companies believing they're getting Stage 1 returns. Stage 5, the gap between story and substance becomes impossible to ignore, and it closes, usually fast and usually painfully. We saw this exact 5-stage pattern with railroads in the 1840s. We saw it with radio stocks in the 1920s. We saw it with the internet in the late 90s. We saw it with crypto in 2021. The technology in every single one of these cases was real and eventually changed the world. And in every single case, a huge percentage of the companies riding the initial wave went to zero, while a small handful became some of the most valuable businesses on Earth. The skill that separates the winners from Barbara in Ohio was never enthusiasm for the technology. Everyone had that. The skill was the discipline to ask which specific companies had real, durable economics underneath the story. So here's what I actually want you to do, starting the moment this video ends. Stop asking, is AI going to change the world? You already know the answer, and honestly, so does everyone else, which is exactly why that question is useless to you as an investor. The question that actually makes you money, or at the very least protects you from losing it, is far less exciting, and that's precisely why almost nobody asks it. Which specific companies, with which specific balance sheets, are positioned to survive even if the hype cools off by half? Which of these businesses would still be worth owning if the word AI completely disappeared from every headline tomorrow? If you can't answer that question about a stock you own, I need you to sit with that discomfort for a second, because that discomfort is information. It's your own subconscious telling you that you bought a story, not a business. I genuinely want you to succeed here, which is exactly why I'm not going to sugarcoat this. The market does not reward you for being early to a trend. It rewards you for being right about value, and sometimes those two things happen to overlap, and sometimes they don't, and mistaking one for the other is the single most expensive habit in investing history. Barbara didn't lose her retirement savings because the internet was a bad idea. She lost it because she stopped asking questions the moment a story felt exciting enough to skip them. So before you buy the next AI stock that shows up in your feed, or before you keep holding the one you already own out of habit rather than conviction, ask yourself the only question that has ever actually mattered in the history of markets. Am I betting on this business, or am I just betting on everyone else's excitement about it? Because those are two very different bets, and only one of them is actually investing.